Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is September 30th of 2022. Everyone here is, of course, getting this recording on the Monday. So wrapping up the end of the month, the end of the quarter. And I'm glad to report that despite sort of a really bad month for the stock market, I believe the S&P, don't quote me on the exact percentage here, down around 8 to 9% for the month of September, down 4 to 5% or so for the quarter. We like the way the portfolio is positioned. We have a ton of work to do because January through April was a painful time period when we were on the long side of the market, when we were in growth. But again, we do like where portfolios are positioned right now. We do think we're approaching the second phase of the bear market in the right way. And there's going to be a time when we're going to need to pivot again, and we're going to need to pay attention to the numbers. We're going to need to make sure that we are what we call disciplined followers of what is happening and not trying to pontificate of what will happen. And I think that's really, really important with markets. You get a lot of people out there that are trying to say, here's what's going to happen. I'm going to be this soothsayer. The most disciplined way is to follow what is happening and then prepare the portfolio to adjust for the reality. And the reason for that is, quite frankly, that there is what we call a persistence factor in the current state of things. And so that's what the approach that we're taking. We think we're doing the right thing here, and it's just a matter of closing out the year strong and then pay attention to both short-term and long-term interests as it relates to the overall portfolio. So let's go ahead and get started now. The presentation for this week is "The Queen is Dead." And the reason why we made that quote is it feels like ever since the Queen passed away, the UK has gone down this vortex. And what happened this week with the UK bond market, we think is really, really, really important. And it's also important to get the right takeaway from it, not the wrong takeaway as we saw on Wednesday in the stock market. In general, we think that what happened with the UK bond market is symptomatic of something more widespread across the globe. Whether that's a deep recession, whether that's credit market issues, whether that's a failure of some systemically important institution, we don't know, and we don't need to know. We just need to understand how it impacts risk and how it impacts the risk footprint of our portfolios and our client portfolios, and then make the right decisions based on that. So we're going to go through three things this week: what happened in the UK bond market and why it matters, identifying the difference between a short cover rally and a more durable market bottom, and lastly, trying to understand are valuations attractive after the recent sell-off. So Wednesday's rally really was a wacky rally. I mean, the market was up a lot on this news that the UK bond market was the Bank of England was going to come in and buy bonds and restart QE, and everyone was like, that must mean I need to buy Bitcoin and profitless tech and all this other dog crap out there that hasn't performed over the last year or two. No, that should really not be the takeaway from what happened on Wednesday. What really happened on Wednesday is market was down 6 days before this, and it was going to take any sort of random headline that would not have mattered a week ago to trigger a short cover rally. How do we know it was a short cover rally? Well, we don't really know, right? Unless you're at the specific desk of all the hedge funds out there. But short cover rallies give some symptoms of how they may be that exact reality, which is volumes were down significantly on Wednesday's rally, down between 50 and 65%. This chart here from Hedgeye, great chart. Thank you for that. And then, of course, we look at the percentage of stocks that had a 2 standard deviation move. Now, when you're near a market bottom, say like March of 2009 or March of 2020, March seems to always be that key month, but you get an explosive rally where, in other words, 60 to 70% of stocks of the index have a daily advance of 2 standard deviations. In other words, it doesn't matter if it's a crappy company or a great company, they're all going to go up like 10, 12, 13, 14% on the day. That's what we call a 2 standard deviation daily advance. Why? Because the world has suddenly just gotten less risky. And so bad actors, good actors, they all go up in value. We didn't really get that we didn't get that animal spirits rally on Wednesday. Only 8% of stocks had a 2 standard deviation daily advance. So we have to really sort of check our enthusiasm at the door and use a day like Wednesday to unload some inventory. Got a little bit of that on Friday morning as well, the day that I'm recording this. And we used, again, Friday morning to unload any inventory that we were looking to unload. Bought a little bit of energy, bought a little bit of gold, and then, solidified our hedges. So that UK debacle, the markets rallied again on this thought that, oh my God, Bank of England's going to restart QE. They're the precursor to the Fed restarting QE. That's not the message to take. This was a really, really bad sign because the Central Bank of England, the Bank of England, a day or 2 days prior to buying bonds again, were just about to launch quantitative tightening. In other words, selling bonds, a program that they've been designing for a really long time. And in a day, they had to do a complete 180. Why? Because the British bond market froze. It fell apart. It crashed. That's not a good thing. The fact that they had to step in and do this is not a good thing. So we think it's a really, really bad sign. And the first sign, the first domino in what's a broader, more global issue with credit markets and the impact of rising interest rates, the unwind of quantitative easing, and of course, systemically high inflation. We think something's going to break. We don't know what it is. So this is not a sign to go and buy Bitcoin or profitless tech. It's a sign to batten down the hatches, in our opinion. And this was the move on British gilt yields over the last week. If you're looking at 30-year British gilts, they went down in price. So this is the yield. So when yields go up, price comes down. The price of these bonds went down 25% in a week. Risk-free British bonds. Doesn't sound risk-free. They went down 25% in price. These are not normal moves for a developed world bond market such as the UK, which used to be the reserve currency of the world prior to the American dollar. So really important. We see that the FX, the currency market, is at the center of the current storm. The British pound is down 21% year to date. That's from a couple days ago. There is fluctuations there. Japanese yen down 20%. By the way, these are reserve currencies. They are down 21 and 20.5%. The euro is another major reserve currency. It's down 15.5%. And by the way, speculators are still net long the euro. What does that tell you? We think there's probably more downside to the euro and more to this story to be written. Stay tuned, right? And that's because when inflation is running rampant, the central banks cannot step in for the most part and do permanent QE like we've been seeing. They can do one-offs like you saw with the Bank of England, but generally speaking, they can't subsidize government spending. So you get this complete unwind of the previous QE regime of the last 10 years. And we see that stress is starting to build in the credit markets. Credit spreads are widening across the board. In 2020, we had this huge explosion upward in credit risk, but that was because things shut down, right? It was like you snap your fingers overnight and you had this huge explosion, and then equally impressive reversal. This has been more gradual, something that reminds us more of the 2000s than 2020. And we're starting to approach these 2020 levels. So if credit spreads are getting close to the wides of 2020, why can't the equity markets revisit the lows of March of 2020? We think they can, and we think they will. And then the other argument is, well, markets must be cheap. Valuations, we always have to say to people, they're not an absolute game, they're a relative game, right? Tell me where interest rates are and where they're going. I'll tell you kind of my idea of where I think valuations are going. You can support wide multiples on stocks when interest rates are at zero and the central bank is printing money. But when central banks are reducing money supply and when interest rates are going up by a historic fashion, these valuations tend to contract quite rapidly. And yes, we've had a contraction in valuations, but we're only back to the 2000 peak, And what did stock prices do back then from its 2000 peak in valuations? They went down dramatically. The only difference is interest rates were at 1% back then at the peak in the market. Here they were at 0%, and we had quantitative easing. We didn't have quantitative easing back then. And then the other area we want to make sure people are aware of, we saw a lot in the press this week talking about the percentage of stocks at 20-day lows has massively spiked. That is capitulation. You got to go in and buy stocks. Not so fast. Here's the thing, is that stock markets tend to bottom after the percentage of stocks at 20-day lows has already bottomed out as well. So we see here in 2001 and in 2007, a similar thing happened where the percentage of stocks that were at 20-day lows spiked and hit a peak earlier on in the bear market. But when it finally bottomed, the percentage of stocks hitting 20-day lows had already started to decline. Same thing happened in 2007, 2009. Markets bottomed in March of 2009, but your average stock actually bottomed far before that in November and December. But if you were long the index or you were long the biggest stocks of the index, you still had a lot of pain to swallow, right? So we need to be careful here is the bottom line message. Two-layered approach, be careful with the indices, be careful the biggest stocks such as the Apples, the Googles, the Microsofts of the world, the United Healthcares of the world. These are the ones that are top heavy, that represent the biggest weight of the index, and therefore they're the last soldiers standing or usually the last ones to get shot. That's how bear markets work. So we want to take a two-layered approach. We want to play the protective game, right? We want to have those hedges in place. We want to play defense. Underneath the hood, in terms of those gross long exposures, we want to try to identify sectors and stocks that are acting well on a bad tape that aren't recession-proof stocks. Because yes, utilities and staples, those types of recession-proof areas are going to be acting well. But we don't want to buy those at the worst point of the recession, because guess what gets sold when things get better? Those stocks. We want to understand what are the risk-on areas of the market that are acting a little bit better underneath the surface in a vicious bear market. And we think the bear market still has legs here. I mean, the yield curve, whether we're talking the 2-10, the 3-month 10, or even the the 1-year 10-year. So my little bit tired today, but the 1-year 10-year curve, whether across the board, what we see is deep curve inversion, and that is not a sign that we want to be taking risk right now. So bottom line here, ladies and gentlemen, nothing has changed. The Fed continues, and they reiterated that with Fed speakers this week. They are going to hike interest rates into an economic slowdown. That's bad for risk assets. What happened in the UK was bad. You want to play defense. It's not a sign of all systems going. Days like Wednesday are typical short cover rallies. Use that to unload some bad merchandise. And lastly, a portfolio does remain net short. We did buy some gold and some energy exposure. Why? Because their correlations are a little bit less to the overall market. So we want some correlation diversification there. So that's what we got for you this week. Number is 888-543-3776. Have a great week and talk to you soon.